I'm Bill Oughton of Oughton Claims Management.
I'm Chantal Roberts of CMR Consulting, and welcome to the Art of Adjusting podcast.
Today, we're going to talk about life as an insurance adjuster from the perspective of property, auto, liability, or workers' compensation adjusters. Our goal is to bring interesting topics in the world of claims adjusting to people who are working as an adjuster now and to people who are considering a career as a claims adjuster.
Hey, Sandy, how are you?
I'm good, Chantel. How are you doing?
I need a nap. I don't know about you. It is nap time for me. And we're going to talk about a very exciting topic, which is going to be reserves, bankruptcy, and insolvency for insurance companies, which ironically, I just got finished teaching my risk management students. We just got finished doing like all of the, what is a loss ratio and how do we determine it and blah, blah, blah. And yeah, so I'm kind of a little mathed out.
Yeah, insurance math.
Yeah, insurance math. We were just talking, and I had said, why do adjusters need to know what an insurance company's bankruptcy or insolvency is? And you had said, well, you know what? It might be because we need to set reserves.
hmm Yeah, when I first started out as an adjuster, I remember, being told you had to have reserves, and at the time, not having we talked about this a little bit, not having a holistic view
Mhm.
of the insurer of my organization. I only knew my role, and so I knew I had to have reserves because I needed to make payments, and I need to have enough reserves to cover those payments. And even though you're reserving for the most probable outcome of the claim, I hadn't realized it until much later how important that was. That wasn't just make sure you have enough reserves to cut checks, because that becomes a whole stair-stepping issue. We could talk about that too, the stair-stepping
Right.
problem. Um, but it's important because there are other people who are relying on your data to make decisions that affect the entire organization.
Yeah, and I think that right there is the entire takeaway within what the first 3 minutes of the podcast. So great podcast. Let's all go take a nap. Woo, we're done. No, I think that is exactly what we need to focus on and explain to the adjusters because I was the same way when I became an adjuster. I was just told make reserves, make it for the most probable outcome and we will get into stair stepping or we'll talk about it because it's important to the insurance company
Mhm.
to maintain solvency. And I'm like, I've been here 3 months. I don't know what that means.
Yeah.
And and one of the reasons why I picked this topic was actually based off of a TikTok video that you had posted on LinkedIn again. Y'all, if y'all aren't following Sandy on TikTok or Insta or any of, those things that you cool hip kids do nowadays, or LinkedIn, do so, absolutely do so. But it was this great little video where you were explaining the difference between bankruptcy and insolvency using SpongeBob. And even me with 25 years plus, I was like, oh, I get it. So I'm going to turn it over to you now. I'll let you talk.
Sure. So the meme was, oh, this is gonna be, I'm gonna sound so old trying to describe a meme, but go watch the video. It's worth it. But
The
let me
video's
try to
better.
explain this meme. So, and I just did this with SpongeBob images, but essentially, insolvency is justified. It's a financial condition. You don't have enough assets to pay your liabilities, and in the insurance world, your liabilities are your claims. You have to have enough money to pay your claims, but insurance is one of those products where we sell it without knowing how much it's going to cost in the future, because you sell a policy today and you don't know how those claims are going to develop. So insolvency means you don't have enough assets to pay your claims. And that's where the insurance as professionals come in, your adjusters, because everything is an estimate. And I think it's important for adjusters to know everything is the actuaries do some very, insurance math magic above my head that I don't know how to do, but they apply some insurance math magic to like kind of forecast into the future how much they think those claims are going to cost. But what they're using, a big component of that formula in that insurance math magic, is the reserve set by the adjusters. So the actuary is making an estimate, And that estimate is based on another estimate that's made by the adjuster. And so that's why it's so important for the adjusters to make sure that they're reserving appropriately, because the actuary is taking that to figure out how much money we need to charge for premiums, how much money has to be set aside for these claims in the future. And so it really is important, because the step after insolvency is bankruptcy if that financial state doesn't change. So insolvency is like being sick, it's a condition. You can get out of it. It's tough, but you can. And then bankruptcy is like going to the hospital to get treatment. You're going to the hospital to get treatment to hope that you don't go down that road or get worse. So that's kind of the difference. But in the insurance world, we talk a lot about insolvency and not bankruptcy, and it's good for adjusters to know that kind of is that step when they're going in that direction. Is if your organization is insolvent, that's not a place where any insurer wants to be.
Right. And I think that, and this is what, of course, I always thought that insolvency meant bankruptcy.
Mm.
And that's why your video was kind of like a light bulb aha moment for me when I was like, oh, okay, so insolvency is like being sick, and then bankruptcy is actual like the location, like at the hospital or whatever. We
Mhm.
don't want to be there. And of course, we don't want to be insolvent either. And I think it's interesting that you said that we are all basing everything off of an estimate, and it's our best guess. Now, I will say, because a lot of times carriers are now doing these set reserves that are based off of the historical data that they've had,
Mm.
and adjusters are no longer having that control over setting the claim reserve. And so, like me, I've always set the claim reserve, and you just get to know what it is. Windstorm, hail, roof, whatever. Yeah, 15,000. You just start getting to get a feel for it, or something like that. But now a lot of the actuaries or the insurers, I think, are setting, these set reserves like, oh, okay, there's a hailstorm in Texas, 7,500, based off of the historical data. They've taken all of their hail in this particular zip code or county or whatever, divided by however many claims they've had, and boom, that's your statutory, or not statutory, but that's your, I don't know.
Your ballpark.
Yeah,
Yeah.
but it's set by quote unquote the system.
Hmm.
And maybe it's a better guess. I don't know. But
I have some mixed feelings about that. I mean, I understand the intent, and if they're looking at total paid, this is what it's most likely to be. But I think reserving really is both an art and a science.
it is.
So the science portion is the what have we historically paid on these claims? And there's all kinds of great tools now. When I started my career 20 years ago, you had to ask your neighbor, and you had your own little list of how much things cost that you would keep, and as costs changed over time, you had to update it. But now there's more tools. And I think that's the intent of kind of that AI driven, here's what this loss based on this state and these factors will cost. But there's some nuance missed there.
Yes,
And I know I've heard a lot of the TPAs and insurance say, well, the adjuster can go in and override it if they, but when you create that barrier, when you create that additional, and they're already so busy, they're gonna say, like, well, hey, you said AI
exactly.
is going to do the job. AI set the reserves. And so we have the science portion nailed down, and we're missing the art portion of reserves. And that's really important, especially if you think of bodily injury claims and workers' comp claims where you're dealing with medical things.
Mhm.
And there's so many variabilities that I get a little bit nervous about AI being used to set those reserves, because is it taking in all of the factors in the outcome of someone's condition? And then how good is that data? That's the other piece, right? So they're pulling in information that's entered, but what if it's wrong? So what are you training your AI model on? So uh,
Exactly.
on the fence about that.
I am too, quite frankly. And of course, I'm always of the opinion that while I feel that we should help the adjusters, and the way that we help the adjusters is not necessarily by giving them more tools or more metrics or whatever, it's getting more butts in the seats. so that they have less claims to work, so that they have time to do these sorts of things. But that's a whole nother podcast, whole nother podcast. But the I feel the same way because I have seen it happen way too many times where, of course, you and I were talking, just mentioned stair stepping.
Mhm.
And what the adjuster will do is not, like you said, pay attention to the reserve. The initial reserve will come in and the initial reserve is set as soon as first notice of loss comes in, whatever. They won't look at it, they won't do anything about it, and they won't change it until they either get an estimate in or, goodness forbid, they get ready to change, to do the check and then they'll change it. Oh, well,
Mhm.
you know, that could be a bad thing. Uh, and it could also be the fact that, okay, we change it and then we're not ready for, I don't know, the ordinance and law clauses or the debris removal clause, things that we will need to reserve for, and then we up the reserves again. And that's what stair stepping is. If you don't know what stair stepping is, just to define it real quick, because you know me, I love definitions, is where you start off with one reserve and then a few weeks, few months later, you'll go up to another one, and then you will go up to another one, and then you'll go up to another one. And if you're working as a third party administrator, it really pisses off the carrier because the carrier is like, dude, I need to know so I don't get sick, i.e. insolvent, because you as the one lone adjuster out there think that you're not that important. But what the insurance company is actually doing by law, by state law, is taking that $15,000 that you originally said that roof is going to cost, and it's putting it in a whole different account, an account they can't touch until you write that check. That's what a quote reserve is. And it's not just some kind of number that you type into your, I don't know, your system. I mean, it literally triggers the bean counters to go, oh, we need to pull $15,000 and put it off to the side for
Yeah.
this one claim. And remember, they got to do it over the thousands of claims that they have.
And I think one of the things that the couple things contribute to stair stepping. One, it's what you mentioned earlier, it's the butts and seats. It's
Mhm.
people are busy and they're like, I just need to get this check out. And so I'm just going to put in enough money to get this check out and then move on to the next thing. So and I think this is, again, I think we have a lot of conversations. We're like, this is a whole other podcast. But a topic would be there are these AI solutions for things that nobody said was a problem. I have not heard adjusters mention reserving was the issue of why they can't things done. We need more people. But that side note. The second thing, and this is the important one for self-insured programs, a lot of times the stair stepping occurs because you have a self-insured organization who wants to approve the reserves before they're posted. And that always drives me crazy because now you create another barrier. And I'll hear from adjusters who will work with a self-insured group and they'll say, well, you can't anything over, X amount of dollars, you have to get our approval. When you create that barrier and they're trying to get things done, they're going to stair step because they don't want to have to go through the process of I email you, I wait for the response, I got to email you again because you didn't respond, and now it's a week later, it's 2 weeks later, and I'm trying to get this done. I'm just going to enter a little bit to get these checks out, and that's it. So I always tell people if you have an approval process for reserves, why? Are you really looking at those reserves and saying, no, I don't approve, this isn't appropriate to put on the case? Because it's usually just a formality where you want to look at it and you can get an alert as a self-insured group and let that the reserves have been posted. But why be the barrier? Let them post the reserves, get alerts when they've been changed over a certain dollar amount. And then if you are really concerned about that dollar amount, you can call them and have a conversation. But don't create barriers for the adjusters. For the insurance groups listening, the self-insurance groups listening, don't put authority levels on reserves. Get the notification, but yeah, don't create a barrier for your adjusters.
Yeah, I think that that is a very big deal. We would have not limits on the reserves that we set sometimes, but if we set a reserve that went over our authority as a third party administrator, it would automatically trip the trigger that we'd have to report. And we were a third party administrator for certain syndicates at Lloyd's London. And so a lot of the newer adjusters would deliberately hit it right under there, right under until they got ready to, like, I don't know, pay the IA bill or something like that. And then that's when it tripped the trigger. And I'm like, dude, it's been 3 months. Oh, London's going to be pissed. And it is just a formality. Like it's the expense that pushed it over for whatever. But that's neither really here nor there. But what we're talking about is again why the adjusters need to know how to set these reserves, why these reserves are important. And I also do mention to the risk management students that insurance, like I've said before, we are so bad with words. Like we just tend to find one word that we like and we use it for everything. Reserve is one of them. I mean, like the accountants have their reserves, the insurance company itself, like I said, have reserves. Like the statutory amount that they have to keep off to the side. And then there's the per case or the per claim reserve, but that's the one that the insurance adjuster is putting, and yeah. And of course, we have lots of different reserves for lots of different things. We've got the indemnity reserve, the expense reserve, the defense reserve. Sometimes I don't know how now I don't necessarily know how the big carriers do it, but I remember how we did it with the third party administrator. Like we broke it down into like 4 or 5 categories. I don't know
I
like
still see
how State Farm or Geico or how they do it. I know it comes out of different LAE parts, even though one reserve may be hit, but
I still see it allocated that way. They have everything in different buckets. And and again, every organization has different rules, right? In terms of you have enough reserves here, and then may pull from a different area as long as there's enough reserves in total versus maybe you have to have it in that category. But that's again why it's so important to look at making sure that you are really reserving for the most probable outcome and not just get what gets you through your tasks for
mhm.
the next couple weeks. Another thing we had talked about too is understanding as an adjuster when the actuary is pulling that data to
Yes.
model for the next year. So the actuary will, so if you're an adjuster and your leadership hasn't, sat you down to kind of give you this education, which I never got that benefit. It was, you have to kind of seek your own professional development out sometimes as an adjuster. But what they do is the actuary will take a date out of the year and they basically take a snapshot, this point in time. I'm pulling all the reserve information as of today and whatever that day is. So for some organizations, it's June 30th, end of fiscal year. For some, it's December 31st. Whatever they're using, they're picking a day. And that's good for you as the adjuster to know, because if you have some claims where you're like, oh, some stuff has changed, I do need to look at that and update the reserves. You know that it's really important to make sure it's updated before snapshot day.
Yes.
Snapshot day, they're taking that data and that's what they're going to use for the next year.
It's like your picture day. You want to make sure that
Yeah.
your hair is all nice and you got your makeup done and your favorite sweater, and all that for your school photos because it's going to be in the yearbook for the rest of your life.
Yeah.
Again, it's really funny. I just got finished doing this with my students, and Professor Roberts was a little mean with the students because I had them do the loss ratio based off of the balance sheet. And then all of the other ones, I had them do it off of their numbers, their figures, and everything off of the income statement. And so when I was explaining it to them, I'm like, balance sheet, snapshot in time. Income statement all year long. It's going to be all 12 months. And even though they end on the same date, December 31st. And one of the things that I did for the loss reserve is I asked for unearned premiums or earned premiums. It was part of that, I was asking for earned premiums, but earned premiums doesn't show up on the balance sheet. It's premiums written or premiums obtained or whatever, however I said it or something, just to change it,
Hmm.
just to be mean, just to be mean. And all of them, no, not all of them, a few of them did listen to the hint that I dropped, but almost all of them went to the income statement to pull off where it actually said premiums earned or whatever. And I'm like, you can't do that. You can't go and change all your sheets and all that. And the point of the story is, as an adjuster, again, yeah, you do need to be aware because if you do happen to have like a catastrophe where a semi-tractor trailer rig rolled over a family of four in a sedan or whatever, and you've got paraplegics and maybe a death or goodness knows what, you need to get those reserves up. And probably the answer is how many zeros do you want behind that number? But in all seriousness, even if you're doing a very small bodily injury claim or property damage claim, again, remember all of the coverages that are available to these people. I was the world's worst about debris removal and like I said, ordinance and law, that 10% or whatever, that extra coverage that they could get. I would always forget it. So I would stair step. That's very bad of me, but I would. So,
I think we've all done it at
mm,
some point, right? But
yeah,
and I remember being when you were adjuster and you were audited, we had our internal audits, and you would get your hand smacked if they found stair stepping because they knew if you're just bumping it up like $1,000 here and there over time, that was clearly you not looking at the total outcome of the case.
right.
Uh, but you mentioned something earlier about snapshot, and it's picture day, and it's in the yearbook forever. And I love that because that's true. When the actuary is looking at the next year, they're using that information to determine how much premium they're charging. And so if they don't charge enough premium, they're using like that's all. It's in the yearbook forever. They have to live with what they've collected, and hopefully that covers the future of their claims. So I had seen, I mean, the SpongeBob meme video came out of a story that I saw on LinkedIn or YouTube. I can't remember where I saw it, but it was about American Transit Insurance Company and how they had been insolvent for something like 30 plus years, that they've been insolvent for decades.
How do you do
And
that?
and I think that was like how are you insolvent for that long? And that was a very interesting scenario because they have over 60% of the market for auto in New York City. Very localized, which again, red flags for an insurer.
Oh, yeah,
Localize
yeah, yeah.
all your risk in one place and one thing. So New
Hmm.
York City auto, 60%, and New York City has PIP. So that's another thing, right? I think their PIP limits are fairly high,
Yeah.
and they had been insolvent for so long, but because they have so much of the market, essentially like the state kind of comes in and they're semi subsidizing, because otherwise if they go down the bankruptcy path, if they no longer exist, where's 60% of those drivers going to get their auto insurance?
Yeah.
Because you'll have other carriers who might be there, but they may not be able to take on that capacity or want to, because again, it's all in one place. So it's a really interesting insolvency for carriers, and what happens when you go down that path is a very interesting thing to watch for different carriers. And we're seeing it a lot in challenging states where, like for instance, in California, they
Love
put
that.
a
I'm sorry,
block.
just to interrupt. Challenging states.
I was trying to be nice.
Um, Florida and
Yeah, Florida.
California. Come on.
Yeah.
Colorado.
California, and I say
I'm
this
sorry to
from
interrupt.
California right now. Well, they put a block on carriers from leaving, so
Mm,
certain carriers cannot issue a non-renewal, and so it's a very interesting. If you're adjuster, I always say it's good to understand like holistically how all of insurance works. It also helps for your career development if you wanted to go into different areas to understand all of this, but how this impacts the organization, because you don't just have the challenges of what happens if adjusters aren't reserving appropriately, but you have regulatory challenges that also impact carriers in terms of whether or not they can remain solvent.
Yes. And for our quote challenging states, end quote, I love that. That is like so polite. I'm just gonna name names here.
Name your, I heard, I also heard the term, and I was like, it was like an academic term, judicial hellhole.
Oh,
Is,
no, 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 no. Those states are not judicial hellholes. No, judicial hellholes are a whole different set of states. That's let's see, West Virginia, Louisiana, the southern part of Texas, Florida would count, yes. I wouldn't necessarily count California.
oh,
Washington State is a judicial hellhole. Those are the ones that when you get sued,
mhm,
you want to get out of that as soon as possible because
okay.
that's the one where you're going to get the McDonald's coffee burn 3 billion trillion bajillion dollar verdict. You
See, and
know,
I would have sworn California is on that list.
it may be now, honestly, but I wouldn't really consider it to be so bad.
Not the worst. Oh, that's
Not the
surprising.
that's but
Usually,
that's just me. That's just me. The- Squirrel off base.
yeah.
But yeah, no, it's interesting because we're talking about having these challenging states
Hmm.
where and we've seen it and Florida has kind of calmed down, but what was it 2 years ago where Florida had 11 insurance companies go insolvent and then I think Louisiana had eight.
Yeah.
And California has had some. And again, just talking about the financials of this with my students, and I go, look, guys, here's the deal. If you did not know this, and there's no reason for adjusters to know this either, but I'm going to spill the beans or spill the tea, as they say. And the Department of Insurance is the one that approves the carrier's rates. And if you want to get into conspiracy theory, let's talk. Because for the most part, most states have the insurance commissioner who is appointed by the governor. There are a few states, I think California is one of them, where the insurance commissioner is elected. And so you go as the carrier and say, hey, boss, I need to raise my rates like 5% or something, because, my adjusters are idiots and they're not setting the reserves correctly. And we've had more losses than what we need. And the guy who gets elected or gets appointed by a person who gets elected is like, yeah, no, because why? Naturally, nobody wants to be the one that says, yeah, I'm going to raise your insurance rates. I approved that. I approve this message. And so that is, I guess, another reason why the adjusters need to pay attention to their reserves because I thought it was absolutely hysterical. And this happened in California. And I don't remember if it was Farmers or State Farm, but it was in the Insurance Journal. I think last year, where Farmer, State Farm, whoever it was, some insurance carrier said, hey, we need to like raise our rates like 22% or something like that. And the commissioner was like, you need to go back and do your math again because you like obviously forgot to move a decimal point or something. And the insurance company said, okay, no problem. Like they did 4 years of looking at what their losses were and what their expenses were and all this sort of thing. And they added a fifth year and they came back and they said, did we say 22%? We meant 48.
Yeah.
And I'm like, oh, dang, y'all should have gone with the 22.
Yeah.
But that's kind of, again, why it's important for adjusters to pay attention to our reserves for the snapshot in time, again, because we're going off of or everybody's basing it off of us because again, we're the most important, I think we're the most important cog in the wheel. We're the one, and no one realizes it except me. That's why, again, everybody just needs to hire me.
I mean, yeah, it's also, it's good to understand what's happening in the insurance world in terms of insolvency and how that affects carriers too, as an adjuster, because it helps you know what's going on with your line and with the job market for your line. So if you are working for a carrier that is localized in a state where some of this may be happening, and now your carrier may be going down the path of insolvency, maybe the reserves were great, but again, if there's regulation where they can't raise the rates to collect enough premium for the losses, then you have to look at, are you going to stay within your career field in that line with that carrier, or do you need to make some adjustments?
Yeah.
Because there are some, we'll see a larger carrier, you have like a national carrier, and then they'll have like a subsidiary located in a specific state so that when the rules get tight in that specific state, that subsidiary goes insolvent and they can kind of separate themselves from that smaller subsidiary. So it is an interesting workaround that they do for when we get too much regulation and it becomes an issue in terms of staying solvent.
You have mentioned something that is absolutely on point. And I hate to keep mentioning this over and over again, but again, I gave this to my students. There was a plaintiff attorney blog, not Chip Merlin, but a plaintiff attorney blog where the plaintiff attorney was saying, why is the insurance company having $165 billion, that's with a B as in boy, in profit, yet they are crying poverty and, raising premiums left and right and blah, blah, blah. And there is again this whole conspiracy theory that all this money gets shipped off to Bermuda, blah, blah, blah. I'm going to tell you that it does because that's where they do a lot of the investment. Because how does an insurance company make money? Well, they make money a lot of different ways, but it definitely isn't from premiums. Because
Mhm.
think about it, my premium is what, $1,800 per year on my car or whatever. And if I get my car totaled or even a fender bender now, those things cost like $7,000. So there's not enough insureds to support that. So what they're going to do is take a lot of my premium and go invest it in the stock market. So yeah, they're going to Bermuda or China or Europe or wherever to do that. Anyway, beside the point, um, you're absolutely right that they make these subsidiaries, much like Coca-Cola owns Sprite.
Mhm.
Think of it like that, much like Coca-Cola owns Sprite. So if Sprite doesn't do well, Coca-Cola spins it off. It's the same thing. And if you look at their names, for example, it's State Farm of California, or it's Texas State Farm, or Texas Farm Bureau, or Texas Geico, or Geico of Texas. I don't know, whatever. And that is how quote unquote Geico or farmers or progressive or whomever has these astronomical losses in a particular state, yet right next to that article we see in the Insurance Journal, Progressive has best quarter in 2 years or whatever, with a $5 million profit. Well,
Yeah.
again, Sprite has to pay its toll or its money to, Coca-Cola,
Mhm.
the head company. And that's how Coca-Cola makes some money, from all of its little subsidiaries. Same thing with State Farm and all of those. So it is again really important. There's a lot of dynamics going on in an insurance company that you don't figure out until later. And no one really tells you about it.
Yeah, no, I think that's the tough part is the education out there on the inner workings and how it's not that it's hidden, but nobody makes the effort to make it accessible or presents it in a way that's interesting, which again, plug for me and my social content.
Yes, please follow
Please
her.
follow me. I'm
Because I don't,
riskfluencer.org and riskfluencer on TikTok.
yes.
It needs to be accessible for people so they can understand. But and the start is a podcast about reserves, but it's also going to turn into career advice. It's one of the reasons why it's so important as an adjuster to understand the environment, understand insurers and how they operate, because that's going to help you as you navigate your career. It's going to help you understand when to make the exit before the organization starts to lay off people, before they start to, you'll see those things coming ahead of time. And it's going to help you be ahead of the curve so you're not putting your resume out there when everybody else in your industry is putting their resume out there and trying to get another job. So that all of that information, that education is going to help you. So ask questions. I'm a big advocate of, and I wasn't always like this, by the way, but I'll DM people on LinkedIn if I see their comment and I'm like, huh, that's interesting. I didn't know that. I was like, do you want to meet via Zoom for just 15 minutes? And I just want to chat with you. And sometimes you'll get no because they're like, who's this random?
Yeah.
But sometimes they'll like, yeah, because you'll find another person who's interested in the subject just like you, and they're happy to talk about it. And you'll learn a lot that way. So don't be afraid of that. Don't be afraid to reach out to people in the industry and ask questions. Most of us are willing to help you and tell you, yes, here's where I learned it from. Here's where I got information, and we'll share what we know because that's again going to help you in your career.
Absolutely. Yeah. And you say we started off with reserves and it's going to end up with advice or whatever. I would like to think that all of the art of adjusting is like that because I would like to think that anything we do here, regardless of the topic, is how to be a better adjuster, and how to understand the whole insurance industry. So yeah, plug to Sandy, go follow Sandy. It's
Risk
not risk.
riskfluencer.
Yeah, risk fluencer, because I always want to put the N in there and I'm like, there's no I in there. And it's like, yeah, so go follow her. Absolutely. Everywhere that you kids nowadays are going. Yeah. So I don't necessarily know if there's anything we need to do. It could be just a real short, sweet little podcast in this particular instance. I just wanted to talk about how important it is to do the reserves and how we kind of are the linchpin and the differences, like I said, between insolvent and bankruptcy and how I didn't even know this, what it was, what the
Yeah.
differences were.
Yeah. So this was a good conversation to make sure, other adjusters know. And now that you kind of know the keywords and know what to look for, pay attention in those articles, find out what's going on in your area, in your line of business, how the market is turning. When you hear about carriers going insolvent, read those stories and find out what happened. It's always interesting to see, not that you're relishing a downfall or anything, but it takes a lot to bring an insurer down. It takes a lot to kind of dismantle something. So when you do see someone that goes insolvent, there are probably several factors, but it's always a good case study to figure out what happened.
Okay, so again, just studied this, which is the whole I mean, it's just kismet or whatever that we just serendipity that we just studied this because I did a little triangle on the PowerPoint and it does talk about like several of the factors that cause an insurer to go insolvent, and there's mismanagement. There are, by the way, I mean, bad reserves. I mean, if the adjusters are not setting the right reserves on their cases, on their claims. I mean, you individually could end up tanking it. And you're like, how can that be? I'm just one person. Yeah, you and your 500 compatriots that are, not sitting together anymore because you're all at home. Whole nother podcast. There's the actuarial people who are not using the numbers correctly. There's overstating assets. You, an insurance company is supposed to be using SAP, which is the standard accounting principles, rather than GAAP, which is the generally accepted principles. And the reason is because, again, we are supposed to be understating our assets and overstating our liabilities, basically understating what we have, like cash on hand, and overstating our debt. And like you said earlier, our debt is our claims. And the issue is that the reason we can't price insurance well is because, like you said, we don't know what the final cost is going to be. If we get sued, even for property, like a bad faith claim or whatever, that claim is still open and it's still accruing losses. If we have a bad bodily injury claim, that is going to be there for 2 years and then sometimes more because we go into court and we're going to have more. And we did not take a premium for that.
Right.
Again, $1,800 is not enough to pay an attorney because an attorney's like, yeah, that's like 2 hours of my time. So
Yeah.
y'all need to settle. I'll send you my bill.
Yeah. 2 hours of their time, and then they use that time to write up the budget for what it's going to cost you.
Exactly. Yeah. 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 And they settle right after depositions.
Yeah.
Morgan Dooley, if y'all follow her,
Oh, yes.
she has the spork that she's always telling
Yeah.
all of the stuff. Anyway, follow me for more people. Yeah. So I think yeah, that's it. So do all of those things.
Yeah. Do all the things.
Do
and
all
no
of
more,
the things.
don't stair step.
Yeah, don't stair step. That's very bad. So yeah, I guess that's it. Anything else?
Yeah, just follow Art of Adjusting. Follow the podcast, right?
Yes,
There's
of course.
always
Yeah,
something to
follow,
learn.
share, link, like, whatever, comment, algorithm, blah, blah, blah. Next week, or not next week, but in 2 weeks, super excited. We're going to have a guest, Scott Margraves. And what he is kind of the guru of certificates of insurance. And again, adjusters are probably going, why do I need to know what a certificate of insurance is? Why do I need to know what it, because people will give it to you, especially in construction at defects or whatever. And they'll go, look, I'm an additional insured, you need to pay me and blah, blah, blah. Sometimes you're not. And that's really important. And I will tell Scott this story, but I won't tell y'all anyway. I was flipping through a remodel magazine, basically sponsored by the Kansas City Remodelers Association or whatever. And the president of the organization in his little blurb in the beginning of the magazine, it was an infozine more than anything, said, every single one of the remodelers in our organization will list the homeowners as additional insureds on the certificate of insurance. And I'm like, they won't unless they're paying some extra premium, I think. I don't think that's the way it works. I think you become a certificate holder,
Yeah.
but not a additional insured. I think someone needs to have a conversation with them. Anyway, so that will be on Thursday, August the 14th. This one's going to be released on Thursday, August the 31st. And that is it. So have a terrific week, and we will see you in 2 weeks.
See you soon.
Bye.
Bye.
Thanks for joining us on the Art of Adjusting podcast, where we talk about life as an insurance adjuster.
If you enjoyed this podcast or this episode, please give us 5 stars and a review. It does help the algorithm pick us up.
Hit that subscribe button real quick and tell all of your adjuster friends to check this out as well. For independent adjusting services, go to www.auton.claims. And for anyone interested in working as an independent liability adjuster, go to the Contact Us tab to join our roster.
In the meantime, you can contact me at theartofadjusting.com for consulting and training purposes.